Today, we're going to talk about an absolute giant of investing, a man who quite literally wrote the book on growth investing and ended up shaping the strategy of none other than Warren Buffett himself. We are, of course, talking about Philip Fisher. To really get a sense of Fisher's impact, you just have to look at this famous quote from Warren Buffett. Now, he said this a long, long time ago, and a lot of people would argue that today, Buffett looks a whole lot more like Fisher than his original mentor, Ben Graham. And why is that? Well, see, Graham was all about buying fair companies at a wonderful price, basically bargain hunting. But Fisher, he completely flipped that script. He taught Buffett the incredible power of buying wonderful companies at a fair price. It sounds like a small change, but believe me, it was a total game changer. All right, so to really get our heads around Fisher's philosophy, we need a roadmap. And this is it. This mind map shows you just how all his big ideas connect. It's a complete system for thinking about investing. We're going to walk through this together, piece by piece, so you can see exactly how it all works. So here's what's on tap. First, we'll get into his core idea, what made him such a pioneer. Then we'll dig into his two main tools, the Scuttlebutt method and his famous 15-point checklist. After that, we'll tackle his pretty radical views on when to sell, and spoiler alert, it's almost never. Finally, we'll wrap it all up with his enduring legacy. Sound good? Let's jump in. Okay, first things first, the big idea. You have to remember, when Fisher published his masterpiece, Common Stocks and Uncommon Profits, way back in 1958, what he was talking about was, well, it was revolutionary. It completely shifted how people thought about investing for generations to come. And this is the absolute key to his whole approach. Fisher wasn't hunting for cheap stocks based on a bunch of numbers. Nope, he was more like a financial detective. His whole mission was to sniff out those truly outstanding businesses, companies that had that special something that would fuel their growth for decades. So you're probably wondering, okay, that sounds great, but how on earth did he find these amazing companies? Well, that brings us to his most famous tool, something he called the Scuttlebutt method. And really, you should think of it as investigative journalism, but for investors. The central idea of Scuttlebutt is that the most valuable information, the real story, isn't going to be in a company's glossy annual report. Fisher was convinced it was out there, in the real world, on what he called the business grapevine. This is where you find all the insights that don't fit on a spreadsheet, by actually talking to the people involved. And he had this brilliant process for it. He'd pick an industry, find about 5 of the key players, and then he'd start his investigation. And here's the master stroke. He'd ask executives at one company for their brutally honest opinion on the strengths and weaknesses of their 4 main competitors. I mean, how smart is that? It's just a genius way to get an unfiltered look at the entire competitive landscape. And his detective work did not stop there. No way. He was building a complete 360-degree view. He'd talk to customers to see if the products were actually good and if people were loyal. He'd talk to suppliers to understand how efficient the company was. And get this, he would even track down former employees to get the real inside scoop on the company culture and what management was really like. This whole Scuttlebutt process was just a powerful filter. Yeah, it was super time-consuming, but it allowed him to just weed out all the average companies and focus all his energy on the few truly promising ones that were actually worth a deeper, more rigorous analysis. So once a company actually passed that tough Scuttlebutt test, Fisher would bring out his second major tool, a rigorous 15-point checklist. This was all about getting to the qualitative heart of the business, and we can basically group these points into 3 main themes. The first theme is all about the business itself. Is it actually built for growth? Fisher wanted to see a clear path for big sales growth for many, many years. He looked for companies that were the most efficient, the lowest cost producer in their industry, because that gives them a huge competitive advantage. And crucially, he demanded a management team that wasn't just obsessed with next quarter's earnings, but had a genuine long-range plan. The second theme, a relentless focus on innovation. For Fisher, a company's commitment to research and development wasn't just a line on a budget, it was its direct connection to the future. He looked for an obsession with R&D, a constant drive to improve and ask, what's next? He knew that complacency is the absolute enemy of long-term growth. And finally, the third, and you could argue, the most important theme, people. Fisher believed that the quality of management was everything. He demanded unquestionable integrity and that long-term vision. He also knew that a company is only as good as its people, so he looked for things like excellent employee relations, high morale, and low turnover. To him, those were all signs of a really healthy, well-run organization. Okay, so you've done the scuttlebutt, the company passed the 15-point test with flying colors, and you've bought the stock. So, now what? This is where Fisher's philosophy gets really, really radical. His answer to when should I sell was basically, you don't. He believed the biggest mistake an investor could possibly make was selling a truly great company way too early. Just think about that. After all the work of finding a wonderful company, most investors are tempted to sell for dozens of different reasons. But in Fisher's entire philosophy, he argued there were only 3 legitimate reasons to ever part with a great stock. Just 3. So, what were they? First, you made a mistake. Your initial analysis was just flawed and you need to admit it and move on. Second, the company itself has changed for the worse. It no longer passes that 15-point checklist, its fundamentals have gone downhill. And third, and he stressed this was extremely rare, is when you find an opportunity that is dramatically better. And this really gets to the heart of what he just considered noise. He was adamant that you should not sell just because the stock price went up a lot. You shouldn't sell because you're afraid of a market crash or because of some scary headline you saw. For Fisher, all of that was just irrelevant, short-term distraction. So when you put it all together, the detective work, the focus on quality, that extreme long-term holding period, you get a powerful and truly enduring investment philosophy. Ultimately, Philip Fisher's lesson is really this. True investment success comes from having the patience to find those extraordinary companies and then the conviction to hold on to them through thick and thin. It's a powerful reminder that what matters most is not timing the market, but time in the market. Which leaves us with a final question to think about. In a world of high-frequency trading and constant news cycles, does the patient, methodical, detective style of investing that Philip Fisher championed still have a place? It's a question worth considering. Thanks for joining me.